Stop writing, please. Good morning. We're going to chapter 13, business, statement of financial position. When we talk about statement of financial position, it simply talks about the position of a business, what the business owns and what is owed. So that means we're talking about the value of the business assets, the liabilities, and the capital. So I'm going to say them differently. Stop writing, please. We call them liabilities because these things, they are resources used by the business, but they do not belong to the business. That's why we call them liabilities. They are resources used by the business that does not belong to the business. They use it. The business uses it, but it does not belong to the business. That's why we call it liability. For assets, these are the resources that the business is using, but it belongs to the business. Example is the building here. It belongs to the school. It's an asset to the school. For liabilities, it could be mortgage. Maybe the school take a loan. So that's the liability. The school uses it, but the school has to repay back, has to repay the lender. Then we have capital. The owner of this school, the owners, they would have put money into this school. Because the school has to be treated differently from the owners. We call it business entity. So the business must be different from the owners of the business. So if the business has to be treated separately from the owner of the business, it means whatever amount the owner of the business puts into the business, it has to be treated as capital. Do we get capital here? The amount of money invested by the owners of the business, which simply means the business is owing the owner of the business too. So as soon as the owner of the business takes money from the business, we call it drawings. Drawings. This means the owner of the business has withdrawn a certain amount of money from the business. Are you guys getting it, please?
Yes.
So, for us to know how big or small our business is, how we're going to be able to pay our loans and whatever we have, we get to know through the statement of financial position. When we are calculating our profit, we use the statement of profit or loss and other comprehensive income to calculate it. But when we want to know the worth of the business, we use the statement of financial position. Are you guys with me?
Yes.
Okay, so like I wrote earlier, it's the record of the company's assets, liabilities, and capital. Now we know what assets are, right? The resources that the business owns. These are assets. Examples are equipment, fixture, land, cash, bank, trade receivables. I want to talk about trade receivables here. We're talking about the credit customers. Sometimes the business sells without taking money from the customer. So those customers are called trade receivables. So it is expected that they pay back within a year. We call them trade receivables. Hello, can I just stop that already? We call them trade receivables. It's part of the money the business will have at the end of the year. Because the credit customer must pay back. Do you understand trade receivables here? Do you understand trade receivables, please?
Yes.
So we have assets, we have liabilities, we have capital done. So this is a typical format of a statement of financial position, which means it talks about the assets of the business, the liabilities of the business, and the capital. So we have three sections here. We have the assets, we have the liabilities, which ends here, and the capital. So I'm going to take one at a time. So for the non-current assets, why do we call them non-current assets? We call them non-current assets because they are expected to last for more than a year, like the building, like the equipment, like the board. They are non-current assets. We can use them, we've been using them for the last more than a year, yes or no? So we'll continue to use it for the next 2, 3, 4, 5 years, yes or no? So for the fact that we can use them for as long as possible, we call them non-current assets. We understand non-current assets here. These are resources that can last for more than a year within the business. Then we have, so examples are land, building, machinery, motor vehicle. All these resources are expected to last more than a year, yes or no? Good. Then we have current assets. Why do we call them current assets? We call them current assets because they are expected to last within a year. So their tenure must not last more than a year. So they are expected to finish up within a year. We call them current assets. That's why these are assets that are expected to be used up within a year. Example, the cash, the amount of money you have with you at hand. The cash at bank, the one you have in the bank, it's not going to stay in the bank. You will use it to buy equipment, you will use it to buy inventories, yes or no? So that definitely we have to use them. Trade receivables, I explained that already. These are your credit customers. Then we have inventories. These are what the business sells. The business is trying to sell them year in, year out, yes or no? So the sum of the current assets and non-current assets give us our total assets. So total asset is non-current asset plus current assets. Do you understand total assets here? Total assets is non-current asset plus current assets. Then go to liabilities. So for liabilities, we have current liabilities, which are debts that are expected to be paid up within a year. They are called current assets. So with current liabilities, we have to pay them back within a year, like an overdraft, like trade payables. Now we have trade receivables, which is your credit customers. These are your credit customers. Sometimes businesses will buy from suppliers on credit too. Yes or no? So if we can sell to our customers on credit, it means we can also buy from our suppliers on credit. So if we do buy from our suppliers on credit, we call it trade payables. Do I have it here? No. Trade payables here. So this means we are supposed to pay back this amount of money, owed to our suppliers within a year. Do you understand trade payables here? Then taxation, we have to pay taxes. Yes or no? That's corporate tax. So the difference between our total assets, stop that already, please. The difference between our total assets, which these are total assets, and the non-current with the current liabilities, gives us our net current assets. So net current asset is total assets minus current liabilities. Do you get it, please? Total assets minus current liabilities gives us net current assets. Do we understand net current asset here? Good. Then we have our non-current liabilities. For non-current liabilities, they are expected to last for more than a year. The bank loan, mortgages, they are expected to be paid maybe 5 years, 10 years, 20 years. So we call them non-current assets. So the difference between our net current assets and non-current liabilities are our net assets. Do you get net assets here? Net asset is net current assets minus non-current liabilities. Net assets, non-current assets minus non-current liabilities. Do we get net assets here? Then we have shareholders' equity. For shareholders' equity, we're talking about the amount of money that the business is owing to the owner of the business. That's what I wrote here. This is all the money that is owed to the owner of the business, because the business has to be treated separately from the owner of the business. So as soon as the owner of the business puts money into the business, it is called capital. If the owner of the business withdraws money from the business, we call it drawings. I talked about that already, right? Great. So one thing about the statement of financial position is that your net current assets, your net assets must equal to your capital employed. So the total of your assets must be equal to what? The capital employed. Do you understand that?
It's not one.
Then it is not balanced. Something is wrong with the trial balance. So that means one of the items are wrongly posted, or you have made mistake from the beginning of the transaction. But they have to balance. The value here, which is our net assets, must equal to the capital employed. Do we get it, please?
Yes.
So for the share equity, we have the share capital, which is simply the amount of money made from the sales of shares. We have retained profit, the profit made by the business that the business is not distributing to the owners of the business. We call it retained profit. Are you guys here? Are you here? For retained profit, it is a profit that is not distributed to the owners of the business, that is putting back to the business. We get this from our statement of profit or loss. Then other reserves, the amount of money we have kept for the business, maybe for financial reasons, maybe for equipment or whatever we have, we kept it there for future purpose. We call it reserve. Then we have drawings, which represent the amount of money taken by the owners of the business. You have to take it away, because all this will be added to the capital, but this has been taken by the owner of the business. You have to take it away from it. So you are adding profits to the capital, you are taking away drawings, because the owner of the business has taken this amount of money. So you have to take it away also. Do we get that? So the total figure here gives us our capital employed. So capital employed is our capital, share capital, That means your capital plus profit minus drawings gives you capital employed. Any question about it? So this is what we call statement of financial position, and we have it to know the worth of a business. Thank you.